What if I told you that most people lose money in ways Warren Buffett never would? It's not because he's a genius, and we're not. It's because he avoids simple, predictable traps that the rest of us fall into, over and over again. Today, we're going to uncover 5 money mistakes Buffett avoids, and we'll look at the science that explains why these habits keep so many people broke. Stick around until the end, because I'll also share a bonus trap that almost every investor falls for, and exactly how you can fix it wisely. Let's start with the first mistake: chasing quick profits. Buffett calls this the investor's disease. Think about it. When you see a stock or a new crypto coin suddenly skyrocket, what's your first instinct? For many, it's to jump in, hoping to double their money overnight. This is pure emotion, not strategy. It's the fear of missing out, or FOMO, driving your decisions. But studies from Yale University confirm that chasing these hot trends usually leads to significant losses. Why? Because by the time you hear about it, the smart money has already made its move. You're buying at the peak, right before the hype fades and the price plummets. Buffett's fix for this is simple but profound. The stock market is a device for transferring money from the impatient to the patient. True wealth isn't built in a day, it's built over decades. You have to resist the urge to get rich quick and focus on building wealth slowly and steadily. The second mistake is ignoring the power of compounding. Most people drastically underestimate how long-term growth actually works. It's not a straight line up, it's an exponential curve. Albert Einstein supposedly called compounding the 8th wonder of the world, and for good reason. Here's a mind-blowing fact. Warren Buffett built over 99% of his massive fortune after his 50th birthday. How? Through the magic of compounding. His early investments didn't just grow. The returns on those investments started generating their own returns. It's like a snowball rolling downhill. It starts small but picks up mass and speed until it becomes an unstoppable force. The fix is to stay invested. Don't pull your money out every time the market gets a little shaky. Even small, consistent returns over a long period will almost always outperform big, short-term bursts of luck. Patience and time are your greatest allies here. Mistake number 3, following the herd. When it seems like everyone you know is buying the same stock, investing in the same type of real estate, or jumping on the latest crypto bandwagon, that should be a warning sign, not an invitation. This is a classic psychological trap known as herd behavior. Behavioral finance studies have proven time and again that this leads to asset bubbles and devastating crashes. People stop thinking for themselves and just follow the crowd, assuming the crowd knows best. But the crowd is often driven by emotion, greed on the way up, and panic on the way down. Buffett's advice is one of his most famous quotes. Be fearful when others are greedy, and greedy when others are fearful. This means you need to cultivate independent thought. When everyone is piling in, that's the time to be cautious. And when everyone is panicking and selling, that's when you might find the best opportunities. It's about buying value, not popularity. Next up, mistake number 4, trying to time the market. This sounds so smart in theory, right? Just buy at the absolute bottom and sell at the absolute top. The problem is, it's practically impossible to do consistently. Even the world's top financial experts can't predict short-term market movements with any real accuracy. And the cost of getting it wrong is huge. Data from JP Morgan shows that if you missed just the 10 best days in the stock market over the past 2 decades, your total returns would be cut by more than half. Think about that. Missing just 10 days out of thousands can cripple your long-term growth. The best days often come right after the worst days, when most people are too scared to be in the market. The fix is a simple mantra. Time in the market beats timing the market. Your goal isn't to be a perfect market timer, it's to be a consistent, long-term investor. The 5th and final mistake is not valuing patience. Warren Buffett reads for hours every single day. He sometimes waits years, not days or months, but years, before making a major investment. He waits for the perfect pitch. Meanwhile, most of us can barely sit still for 10 minutes without checking our phones or refreshing our portfolio. We want action. We want results now. But in the world of investing, patience isn't a passive activity. It's an active financial strategy. It's the discipline to do nothing when there's nothing worth doing. It's having the conviction to stick with your plan through ups and downs. The fix is to reframe how you see patience. It's not about being lazy, it's about being deliberate. Let your strategy work for you and give it the time it needs to succeed. And now for that bonus mistake I promised: overconfidence. Believing you're smarter than the market is probably the quickest and surest way to lose your money. Researchers at the National Bureau of Economic Research call this the overconfidence trap. It causes investors to trade far too often, racking up fees and taxes while chasing bad ideas. They think they found a secret no one else sees, but usually they're just gambling. The fix: keep humility as your most valuable asset. Understand that you don't know everything. Diversify your investments, stick to a plan, and never let your ego write checks your portfolio can't cash. These lessons aren't just for billionaires. They're for anyone who wants to build real, lasting financial security. It's about changing your mindset from a gambler to an owner. Remember, wealth isn't built by speed, it's built by discipline. Thanks for watching Wise Wolf Economics. Subscribe and join the pack. Be a wise wolf.